All right. This will be a fun live. I had a really cool conversation with somebody in the financial space. Hope everybody's having a great start to the week. Uh, this will also be a quick one. I've got a Fiji call in 12 minutes. Perfect, perfect. Just enough time. So was on the call with somebody who is just I guess coming into wealth and sold a business. They were a past client, bought a business. Man, it's been 8 years, no, 10 years, 10 years ago, 2012. My goodness. So 2012, bought a business back in Tennessee. As most of y'all know, back then I sold a lot of deals in the Southeast. I was based in Chattanooga and was doing several franchise things and all of that. So they just sold the business and they were asking me like, how much do you put in your emergency fund? And I was almost hesitant to tell them, or like, or how much do you have left, whatever. I was almost hesitant to tell them because, I didn't want them to feel like, oh my god, like that's crazy. But I like to just be, pretty real with like what's going on, and sometimes traditional advice doesn't make sense for the environment that we're in. And what the environment that we're in right now is obviously a lot of high inflation. There's still a lot of debt and that kind of thing that's still lingering available. And so, in a time like that, the last thing you want to do, especially when there's high inflation, is have cash that's sitting. And obviously, if you have a large amount of cash that's sitting, that's just terrible. And what you want to do is take advantage of inflation. It's kind of these two extremes. You want as little cash as possible, and what you really want to do is have as much debt as possible. So behind the motivation, and I'll get to the complicated stuff and then I'll get to the more simple thing. But behind the motivation, the reason I'm talking a lot about franchising right now, and even trying to do some international franchise stuff, we're doing a lot with franchising within the US. Speaking of international, you guys can see Rio in the background back there. But the reason for that is that franchises are the easiest things to get debt on in private equity. If you look at all of private equity, outside of like Fortune 500 companies, right, really right beneath them because they're kind of apart. When you're getting a McDonald's, what that small bank is doing is like, oh, we're able to make this loan on what essentially is a part of a Fortune 500 business. So it's the easiest place to get debt. And you can get large amounts of debt. We're working through right now a couple deals where we're trying to. We just had a deal where somebody was getting a couple $1 million that's in that space. When you're buying an existing franchise, you can get access to a lot more money. But even if it's a starting from scratch, I had somebody who's doing a Kai franchise here on the channel. It's a subscriber. Shout out to you. I am going to hit you back. But whether you're starting from scratch, whatever, it's just the easiest place to get debt. And the reason you want to be aggressive with that right now is that inflation means that you're being paid to take on debt. So if you can take on debt with a asset that's going to be low risk, but also pay a good amount of cash. And that's the problem with real estate is you can get a ton of debt, but the amount of cash that you're getting is just too low. You're going to get that asset and then you've got to wait 15 years to pay it off. The reason I like buying, even if you're buying an existing franchise, you're buying it at a 2 multiple. So it means whatever you're paying, if you're paying it at a 3 multiple, you're taking on debt, you get all that cash back. You buy this $1 million asset, it pays itself off within those 3 years. And now you're sitting with this asset that you can go sell. You can just take the cash flow or whatever. So the reason that's really important when you're in an inflationary period is that you're basically being paid to take on that debt. So as the inflation, it's just getting more and more outrageous, the amount of inflation that's happening. And you're kind of rooting for that if you have debt on something like a franchise, because you're getting a discount every year. That money is becoming worth less and less, and your prices and everything within that franchise are rising. So it is the epitome. It's just a beautiful, beautiful situation. That's why I'm encouraging y'all to look at those kinds of deals right now. Now, on the other end of that, obviously you don't want cash. And so that gets to the conversation that I just had, which is I have zero emergency funds right now because I would rather take the risk. Now, is that the conventional wisdom is you want to have these emergency funds because if you've got if and you want that in cash, you want that sitting in the bank, you want that maybe we also saw the dollar get broken in the money market accounts years ago, but you want that essentially sitting in cash. And the reason you want that in cash is when you have an emergency, maybe that lines up with the market crashing, and either one or two things happens. At the very least, you've got to take that money out. You're taking it out at a discount. So now you've really realized that lost. And then what if something catastrophic happens and it's the opposite where you lose all your money in the market, but at least you have this emergency fund. And so it's those two dichotomies which say, okay, you've got to keep this in cash because you don't want to have an emergency where you're taking it out at a discount because it's at a loss. On the other end, you don't want to end up in a situation where you really lose all your money, and then this emergency funds becomes, that is the emergency. Essentially, you losing all your money in the market is what the emergency is, and so you've got these emergency funds. Well, so I do, obviously for a lot of people, I think that that's really important. But I think the other side of that is just diversification. So for me, I am willing, to take the first scenario. Let's say, I have an emergency come up and the market's down. I've got to take that money out. I'm willing to take that additional risk on those funds in order to not have, not to lose any money with inflation. So I want all dollars invested. So that's part of it. But the other part is diversification. So, it's not just in the market when I'm talking about things like franchising, when I'm talking about things like, real estate, which, I still do. Shout out to, the amazing team over at the Freedom Family. And when we're doing deals that are just in regular private equity deals, and then so all of that's in addition to just the stock market and that kind of thing. But if you've got that diversification, that decreases the likelihood that there isn't one place that you can take some of those funds out. On the other end of that is, I'm willing to take funds out at a discount and do it, if it's absolutely necessary in a business. So, let's say that we've got a business that's generating a certain amount of income. I would rather, take that fund out, those funds out right now, and maybe not reinvest that back into the business, as opposed to on the other end of the spectrum, taking money out of the market, which has been a little bit of choppy, but I still just think that we're at a time right now where that's going to increase. And so you're kind of making these decisions based on what you think the future is going to be is the bottom line. So where you take those funds out at any given time, diversification basically just creates a situation where you don't have to take it. If the market's down huge, diversification gives you the option of taking it out of, I do a lot of lending. So, I could take it, not reinvest funds into another note and take the funds out from there. So you've got these different options. I'm very much in favor right now of, maybe not zero. You don't want to live on the edge like me, but having as little emergency funds as possible. And on the other end of the spectrum, I'm very much in favor of taking out debt right now, not debt to go spend on stuff you're going to lose money on, not expenses, not cars and even homes that aren't rental properties, but things that are very high cash flow that you can increase when you're looking at the specific thing, like with a business, I think is interesting compared to real estate. It's like, even with inflation, if you're in a lease, you got to wait another year before you can increase that lease. If I'm in a business, one of the benefits in an inflationary period is I can raise inflation is up this much. I'm just tweak the price just a few pennies, each day. You can react immediately, and that makes a huge difference. All right, let's do a few comments, and I'm gonna bounce out to my call. That was perfect timing. Somebody comes in, says, appreciate you, brethren. I appreciate you. Thanks for checking out this quick video. My sister, what's up? Melissa McKeldin, thanks for popping in, says hi. Cowboy Del Norte, Ace the Champ, I certainly appreciate that, man. True Heavy popped in for a sec, said good to see you. And we'll end with the knowledge. Yes. Everybody have a productive day. Make some things happen this week. Talk to y'all soon.